investing is risky, right? Imagine you invested all your money in one single company and the CEO of that particular company resigns. It has a huge impact on the stock price falling off for that particular company. Imagine that another example where you invest in a particular stock and the entire economy goes into recession. Even this has an impact in your stock price. So we saw that in both the cases, the impact on the stock price of that company is the same. But do you really understand there are two types of risks involved? Let me explain it to you in detail. The two types of risks involved here is systematic. One is called as systematic risk. The other one is called as unsystematic risk. In our example, which I mentioned, the case where the management has gone, change in the management had an impact in the price of the stock is a clear example of an unsystematic risk, which is peculiar and unique for that particular company only. Any unsystematic risk could be covered, which is inherent to any company. Uh, Unsystematic risk is inherent risk which is involved by investing in any particular stock of any company. But the risk of each of the particular company stock is unique. So that is called as unsystematic risk. Whereas systematic risk is something which is linked to the market. In our example, what we saw, you had invested and the entire economy went into recession. So this is a case where of a systematic risk which is linked is the risk for that particular company due to the risk which is impacting the entire market. So all the companies in that particular industry will get impacted. This is called a systematic risk. Now let's understand more into systematic and unsystematic risk. First, let us understand what is systematic risk. Systematic risk is nothing but the risk on that particular stock which has an influence due to the market changes. So it is applicable, this particular risk is applicable for all the stocks in that particular industry. So what does it mean? We already saw the link between risk return trade-off. That is, the more the risk, more is the return, right? So this type of systematic risk, in the example which I gave in the beginning, you have invested in a company stock and the entire economy goes into recession. So what happens? It has an impact in the stock price of that particular entity stock. This is a clear example of systematic risk. What are the examples? Like, why does this systematic risk arise? Let me give you examples. Inflation, interest rates, global crisis, budgets, any geopolitical affairs has an impact on the risk on has an impact on the return of that particular stock, the stock price fall or rise. So there is a reason for this stock price fall and rise, right? That is nothing but the risk. The fluctuation of the return is nothing but what we call it as risk, right? So this is a systematic risk example. Systematic risk is assessed and chosen by the investor depending on his or her risk appetite. What is risk appetite? If you are new to this particular video, then I would highly recommend to watch my earlier video where I have explained in detail about what is risk appetite. So if the investor is having higher risk appetite, then he may go for a high risk stocks. If he is not averse to risk, then it is better to opt for low risk commodities or low risk stocks for investing. Finally, now let us know how to calculate your systematic risk. We use capital asset pricing model. CAPM is the method which we use in order to calculate how much is this systematic risk associated to particular stock of the company. The formula which is used is RF plus beta into RM minus RF. Let me explain this formula. In this formula, RF is nothing but risk-free rate. That is a rate at which government bonds are being issued, which gives you a bare minimum percentage, say 6%. So that is nothing but a risk-free rate because It is not subject to any fluctuations and it gives a constant return of 6%. So that rate is nothing but a risk-free rate. So we take the risk-free rate as the base for calculating the systematic risk, and on that we add beta into RM minus RF. So what is this RM minus RF? RM is nothing but return which we get from the market, and RF, as we already discussed now, is the risk-free rate. So what is the market return we get from that particular industry? Market return which we get from that particular industry over and above the risk-free rate. So this differential is being multiplied with a factor called beta. What is this beta? It is nothing but how much sensitive is that particular stock of the company with respect to the market fluctuations, is nothing but that is what we calculate by this term beta. So beta is the sensitivity or volatility of that particular specific stock with respect to the market. So greater the beta, more is the stock, more riskier is the stock, and lower is the beta, less riskier is the stock. So generally, using the beta, we get to know how volatile or how widely the stock price fluctuates is what we come to know looking at the beta. So that is why we tell more the beta is, more riskier is the stock. This is how we calculate the systematic risk. Next we move on. Now we move on to understand what is unsystematic risk. This risk is nothing but that is the fluctuations in the stock price which is specific to the company or industry, specific to that particular company, because in our in our earlier stated example, what did I tell? You invested in a stock of a particular company and the management of the company changed or the CEO resigned. So that is an example which impacts the stock price of the company. So in this example, what happens is this risk is unique to that particular company. The fluctuation is unique to that particular company only. That is a unsystematic risk. This is an example of unsystematic risk. For example, management, labor strikes, bad financial. These are the examples of unsystematic risk. This such unsystematic risk, which is unique to particular stock of the company, could be minimized only through diversification. What do we mean by diversification? We should hold more number of stocks in that particular same industry. Say you have chosen a particular industry, say FMCG, which has a growing market, then in that particular industry, you need to choose 10 to 12 stocks across the same industry and diversify your investment so that your unsystematic risk is minimized. Okay, similar to that of systematic risk, we know how to calculate, right? Similarly, we can calculate the unsystematic risk as well. Let's see. To calculate the unsystematic risk, it is very simple. We need to calculate the total risk and reduce the systematic risk. How to calculate systematic risk? We already know. What is the total risk? It is nothing but what is the variance of the total return. As we already discussed, what is risk? Risk is nothing but the fluctuations of the return. The more it fluctuates, the return, the more the return fluctuates, we call that as a risky stock, right? So risk is associated with the change in return. That's why the total risk is calculated by variance formula applied on the return. And after calculating the total risk, unsystematic risk is nothing but total risk minus the systematic risk. So we already have, so in simple terms, we use this formula, that is variance minus beta square into the market variance square. This is, and we need to square root of that. We need to calculate the standard deviation in order to know what is the unsystematic risk. I hope this series of financial management for the beginners added value to you. So if you are interested to know in this particular topic more in detail, like solving more problems, then I would highly recommend you to comment below and I would come up with my next video in this series. Thank you.